Now that you understand liquidity, the next major banking concept is capital. Because even if a bank has strong deposits and enough cash available, there's another critical question. How much financial protection does the institution have if losses occur? That's where capital comes in. Capital is the financial cushion that helps protect banks and credit unions from unexpected losses. In simple terms, capital is the money the institution can rely on to absorb risk and remain financially stable. Capital helps protect customers, depositors, investors, members, and the overall banking system. Banks face risk every day. Loans can default. Economic conditions can weaken. Investments can lose value. Customers can withdraw deposits. Markets can become unstable. Capital exists to help institutions survive those challenges. This is why regulators closely monitor bank capital levels. Financial institutions are required to maintain certain amounts of capital to operate safely and remain compliant with banking regulations. A bank with strong capital is generally viewed as safer and more financially stable. Capital also supports growth. The stronger a bank's capital position, the more flexibility it may have to expand lending, grow operations, invest in technology, and handle economic stress. Banks generate capital in several ways. Some capital comes from profits the institution keeps instead of distributing. Other forms come from investors or retained earnings built over time. Credit unions also maintain capital, but because they are member-owned, their capital primarily comes from retained earnings. Unlike traditional banks, credit unions do not issue stock to raise capital. This makes strong profitability and financial management extremely important for long-term growth. One important concept in banking is the relationship between capital and risk. Higher-risk loans often require institutions to hold more capital because regulators want banks prepared for potential losses. This is part of what makes banking heavily regulated. Regulators want to ensure financial institutions remain safe, stable, and capable of protecting customer funds. During financial crises, capital becomes even more important. Institutions with weak capital positions may struggle to survive periods of heavy losses or economic instability. Strong capital helps banks maintain confidence, continue lending, absorb losses, and operate during uncertain economic conditions. At the end of the day, capital is one of the foundations of banking stability. Because in banking, profitability creates growth. But capital helps institutions survive risk.
Disclaimer. This content is for educational purposes only and is not legal, compliance, or financial advice. Please consult a qualified professional before making any financial decisions.